It's my great honor to introduce today's speaker, President and CEO of the Federal Reserve Bank of Chicago, Charles Evans. The Federal Reserve Bank of Chicago is one of 12 reserve banks in the Federal Reserve System. Along with the Board of Governors in Washington, D.C., these institutions serve as the central bank for the United States. Since September of 2007, Evans has served as the president and CEO. In this capacity, he serves on the Federal Open Market Committee, which is the Federal Reserve System's monetary policymaking body. He oversees the work of roughly 1,400 employees who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. Prior to 2007, Evans served as the Director of Research and Senior Vice President, supervising the Federal Reserve Bank of Chicago's research on monetary policy, banking, financial markets, and regional economic conditions. His personal research has focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and the financial market prices. His work has been featured by several peer-reviewed journals, including the Journal of Political Economy, American Economic Review, the Journal of Monetary Economics, the Quarterly Journal of Economics, and the Handbook of Macroeconomics. Evans is active in the civic community, serving as a trustee at Rush University Medical Center, a director of the Chicago Council on Global Affairs, a governing member of Econ, Illinois, a member of the Economic Club of Chicago's Board of Directors, and a member of the Civic Committee of the Commercial Club of Chicago and Civic Consulting Alliance Board. He has taught at the University of Chicago, the University of Michigan, and the University of South Carolina. He received his bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University in Pittsburgh. Please give a warm Indianapolis welcome to Charles Evans.
Thank you. That was nice.
Okay, while we're getting set, what did you think of the Indianapolis Motor Speedway? That's a selfish question.
I thought the Speedway was really amazing. It's just a real treasure, and I enjoyed it a lot. I want somebody to go and find out if anybody else has gone around the Speedway while it was snow-packed.
There was a lot of snow there.
I think we got up to 35 miles an hour while we were doing that. But I mean, it's an amazing facility, and hearing the history of it, seeing some of the first car that won the race and others, it's just magnificent.
Well, good. Well, we're delighted to have you here today.
Great.
And we'll move into some of our questions. Reminder to fill out your cards and send up your questions. We've got some to get started, but we want your legible cards so that we can read those. Okay, a little bit about the Federal Reserve. The monetary policy goals for the Federal Reserve are to foster economic conditions that achieve both stable prices and maximum sustainable employment. This is often referred to by the Fed as the dual mandate. The Federal Open Market Committee, or FOMC, as everybody seems to call it, actually sets the policy. So how does the FOMC translate these really broad concepts of the goals into sort of longer run strategies and goals?
Right. So we look at a lot of data. I've got 12 colleagues. There are 12 of us who are presidents of reserve banks around the country. We go to Washington and meet with up to 7 governors. We've only got 5 now, and it's in a big room, and we talk about data that we see, national data. We talk about data in our regions to get a better idea of whether or not something that's happening in Indiana or Illinois is sort of signaling something different about where the rest of the economy is going, our experiences with inflation and things like that. So, what I think of as just being remarkable right now is that the unemployment rate is all the way down to 3.5%. And, we mentioned maximum sustainable employment. The act says maximum employment, but being economists, we kind of go, but it's got to be sustainable, that type of thing. And I think there are a lot of people who probably thought 3.5% unemployment is not sustainable. And if we got down to 3.5%, inflation is just going to be going, through the roof or whatnot. So there are a lot of us who are kind of skeptical about, plumbing the depths of this, but I would have to say it's worked out, remarkably well. The labor market right now is vibrant. More people are sharing in the gains in having a job, increasing their attachment to the workforce, and I just think that that's really good. Those are part of the conversations we need to have and do have at the table, and this is in an environment where inflation has been underrunning our 2% inflation target. So, I think the economy is doing remarkably well, looking at all of that.
Okay. Well, it's certainly been a busy year in your field, a lot going on globally. What do you think sort of the main developments in monetary policy over this last year, and where do you see the economy headed from here? That's a loaded question. But
so interestingly, with the background that the economy is doing as well as it is, we have just gotten to a point where we're pausing in a reduction in our short-term policy rate, the federal funds rate. So we've reduced the federal funds rate target range by 0.75 percentage point, and this is remarkable since the unemployment rate is 3.5% and the economy is growing well. And I think to back up a little bit, we had interest rates at zero for 8 years. 8 years, from 2008 for 8 years, and then we started very slowly, gingerly increasing our policy rate in December of 2015. It took us another year to start raising rates again, and then we started raising them sort of every quarter by 1/4 point. And we got up to 2.25% to 2.5% last December, a year ago. And there was a lot of criticism. Whoa, the interest rates are getting to be pretty high. Financial markets are kind of volatile. And then it became a little more evident that the data were a little noisier. And so we sort of paused at the beginning of this year, and then in the middle of the year with foreign growth around the world slowing down, trade policy uncertainty was slowing down business investment. Consumers very strong, labor markets are strong, but we decided to sort of recalibrate our policy stance, and so now I think we're at a good setting. We're targeting 1.5% to 1.75% short-term policy rate, and I think this is something that can serve us really quite well. But it's been a very unusual ride, if you will, over the last year and further. I think if you sort of asked monetary aficionados, historians, have you ever seen a period where the Fed has sort of done a U-turn and started easing with such vibrant labor markets? They'd kind of go, no, haven't seen that before. I think it's working at the moment.
Talk a little bit, in a lot of the speak out there and a lot of the press conferences, we talk about 2% is systemic, symmetric in many ways. Just define that a little bit more for us. Just a little bit.
Right. So back in January of 2012, under Chairman Ben Bernanke, the FOMC made an announcement that we were going to start acting. We were going to continue acting on monetary policy, but we were going to be very explicit. Our objective is 2% inflation as measured by the Personal Consumption Expenditure Index. And it's symmetric. A few years later, we reminded everybody it's symmetric. So 2% is not intended to be a ceiling. It's not supposed to be, inflation should be lower than 2%, but we're supposed to be symmetric. We didn't really define exactly what symmetry means. There's some technical language that's not really that helpful in our statement, I would say. But I would say that it means we should be averaging 2% over some period of time. It might be that you should spend as much time above 2% as you have below 2%. And for the last almost forever, 8 years, we've been underrunning 2%. During a time when we had said we should be hitting 2%, we've gotten up to 2%, and then we've gone down a little bit. So I think it's important to actually follow through. And when you say you're supposed to hit 2%, you actually do hit it, because financial markets, a whole bunch of financial products that you might be purchasing have an interest rate risk premium, inflation risk premium embedded in them, and they are expecting this 2%, and if we don't actually hit it, then you're paying more of a premium unless markets understand that we're never going to hit it and they price it down. So I just think it's better if we actually follow through on what we're supposed to do.
Chair Powell and others on the FOMC have said that it would take a material reassessment of the outlook to alter the stance of monetary policy. So are you comfortable with that, and what would it take to alter your view?
I am comfortable with that. That sounds like very technical language.
I know it does.
A material event of
material
some
reassessment
sort.
of the
yes.
outlook.
A lot of people have sort of said, I think he also probably said, and some of my colleagues, I think the economy is in a good place. I think monetary policy is in a good place. It's a good time to sort of watch the data, to make sure that the labor market continues to be as strong as it has been. Now, I would expect for it to weaken a little bit in the following sense. We've had a long run of millions of people coming into the workforce, and we've had more people coming into the labor force who are sitting on the sidelines. That's a wonderful thing. People are improving their attachment to the workforce, and so we're able to increase worker hours, and that's good for growth. But eventually it's going to tail off just because everybody is employed, and it's harder to bring more people, unless you're bringing more people in from other sources. So I would expect employment growth to sort of moderate down from its most recent 3-month average of 200,000 jobs per month to something a little bit more like 100,000, maybe a little bit less. But even with that environment, we ought to be able to keep the unemployment rate low, sort of in the range that we're in. I think that's a good place, and I think that I'll be looking for signs that something else might be afoot. It's nothing that I can see at the moment, but if some type of negative event were to happen and consumers get more worried or things like that. But at the moment, I don't see that. That's sort of the materiality, I think, that the chairman is sort of pointing to. Something that we haven't yet seen all of a sudden emerges. And it could be a good one too. It could be the resolution of trade policy uncertainty. Everybody kisses, makes up, decides that we're going to start growing together very strongly, and that would be really quite a boon.
So in your crystal ball, do you see interest rates rising, and if so, when? I'm going to just ask him.
Do you like rising interest rates, or do you like them where they are? Sometimes it depends on who you are. Yeah, it does. It does. I kind of think that I'm personally worried that inflation has been too low. So we've been saying that we should hit 2%, and we haven't hit it for quite a long time. The unemployment rate is 3.5%. I remember having conversations with people, who do this for a living, and they would say, well, easy monetary policy is fine and good, but you can't imagine unemployment being as low as 3.5%, and inflation not going up. That was a couple, 3 years ago or something, and that's exactly the circumstance that we're facing, and yet we still have year-over-year core PC inflation at 1.6%, 1.7 depending on rounding and things like that. I think we need to get it up to 2. I think we need to go with assuredness to 2 in a way that you would be willing to go well past 2, just to make sure that you get there. You want to. You don't hit the finish line at the Indy 500 by decelerating you accelerate through to make sure you get there, and then
I don't know. There's an Andretti that thinks that you do. I don't know.
I don't know.
Sorry.
I don't know. I'm not in on that joke.
Okay. No. It's okay.
That's it. But I think that it's important that we get inflation up to 2%.
Okay, great. Well, I spent a little time Googling some of your speeches. So, things live on in the internet forever. You've been talking about the decline in growth potential for the U.S. economy a little bit. So tell us why we're seeing the decline and what your thoughts are about that.
Right. So I think this is something that's underappreciated by so many people. But if you look at the fundamentals for the economy, which are good, and if you look at what the growth potential is for the economy going forward, our best estimate of sustainable economic growth rates year after year after year is only 1.75%. Now, just to give you some perspective on that, if you go back to the 1982 to 2007 period, that was a time where real GDP grew about 3.25% when we were growing. So 3% is sort of an aspirational rate that many people would like to see. Certainly people running for political office sometimes get into a contest. I can deliver 4% growth. I can deliver 5% growth. Now the question is, what are the fundamentals and how do you get there? Well, it's going to depend on demographics and innovation. It's going to depend on how many worker hours a firm brings on board, and then what those worker hours actually produce. So it's going to be increases in employment and increases in productivity. Demographics are such that it looks like employment, labor hours growth, sustainable year after year is going to be on the order of a half a percentage point. Half a percentage point. Productivity growth, my own assessment, is a pretty moderate one. I'm not pessimistic. I'm not overly optimistic, and I've got 1.25% penciled in. From 73 to 95, we had what was referred to as the productivity slowdown period, and productivity was lower than that. From 95 to 2005, we had a wonderful period of productivity growth, innovation, a lot of things, and it was much higher than this. This is a middle level, so I think it's kind of a conservative, moderate viewpoint. You add it up, you get to 1.75%. So anytime somebody sort of says, but we should be growing at 3%, and I could easily say, I agree. Now tell me the public policies we need to pursue in order to deliver on that, because we do not currently have them in place.
Interesting. In your speeches, you've also spoken about risk management considerations and formulating a path for monetary policy. So again, describe a little bit, define for us what you mean in those references for risk management, and do you see foresee any particular risk, upside or downside, for the outlook?
Yeah, so risk management is one of those things that you point to when you kind of want to do something different with monetary policy, but your normal kind of reading of the data wouldn't necessarily incline you to do that. And so, you know, when the federal funds rate was at 2.25 to 2.5, unemployment was low, inflation wasn't a problem except that it was too low. You could kind of go, this looks pretty good. But then if you do risk management, you kind of think, you know, businesses aren't investing the way that we all expected them to after tax reform and, you know, cutting corporate taxes. The architects of that tax plan were telling us we should see a boom in business investment over some period of time, and we've had some period of time lapse, and we haven't seen that. The consumer's been strong, but if you worry that the uncertainty around trade policy has grown, that the foreign economies are slowing down, the chances of the U.S. economy slowing down seemed tangible to me. And it would be useful for our policy not to be neutral or even a little restrictive, but it would be useful to recalibrate it so that it would be a little bit of accommodate. That's based on risks, on a risk outlook, really. And so it's things like that. The other one is, I think we need to get inflation up to 2%. I'm not worried about it going to 3% because we're having a hard time getting it to 2%, but I am worried if we got to 1% that would be very difficult for us because interest rates would be very low. And if you don't like low interest rates now, you won't like them lower in the moment when inflation is so low. So work as hard as you can to hit your objectives. And when you're not quite sure, think about where the worst outcome lies and try to defend against it. And that's what risk management's all about.
Okay, helpful. The Midwest economy is more manufacturing and agricultural based maybe than some of the other regions in the country. How does the reliance on manufacturing and agriculture, impact our region, and how does that influence your views of monetary policy?
So I know that Indiana is heavily influenced by manufacturing. I think somebody said there's more manufacturing in Indiana than any other state as a percentage of gross state product. My entire five-state district of Illinois, Indiana, Michigan, Wisconsin, and Iowa has a lot of manufacturing. So we pay a lot of attention to it. Manufacturing, as you know, is somewhat cyclical, and so when the economy is doing well, manufacturing is usually doing better, and when it's not doing so well, it could be an early indicator that things aren't going well. Now, the current period is somewhat unusual because manufacturing's on a bit of a decline. The purchasing managers' indexes have gone below 50, indicating that that sector is contracting, but it's not indicating that the national outlook is contracting. And now things seem to be stabilizing. Maybe part of it was the GM strike and some other things. But, so it sort of looks like there was a soft spot for manufacturing, and maybe we're going to bounce back from that. Maybe we'll just, but the trade policy uncertainty hurts that too. So thinking about manufacturing is important. It's important for our district. A lot of times when we go to Washington for the policy meeting, I will report on things around our district. At the end of the day, it does come down to what the national outlook is. And so if we were ever in a situation, where my district's not doing so well, but the rest of the economy is doing tremendously well, and we need to think about positioning policy, it ends up being a national decision. But more often than not, when our district is feeling something different, the rest of the nation usually is going to experience the same type of thing. In agriculture, there's a lot of it in our district. They've obviously been affected by weaker demand. Some of that is trade policy. Some of it is weaker economies around the world as well. And so that factors into farm incomes and what the farmers can buy. So the manufacturing, heavy equipment manufacturers, you don't need to buy a new combine if you're running behind, on your income and can't, struggling on your loan repayments and all of that. So that has an influence too.
Yep. The Fed has engaged in a very much publicized year-long review of monetary policy, strategies, tools, and communications. There was an important conference in June, actually held at the Chicago Fed as a part of that. So what's the timing of the strategy and thinking behind the timing of doing that now? And when do you think we're going to know the results of that and potential outcomes from it?
Yeah, so, our chairman, Jay Powell, had this very interesting and important idea that in the Federal Reserve System, we had not rethought our strategic framework for quite some time. You could imagine that our 2012 long-run statement was a little bit of a rethink, but this was sort of a decision. Let's take into account the new tools that we've trotted out in the last 10 years. We've done asset purchases in high volumes. We've had interest rates at zero for a long period of time, so we've experienced what's referred to as a zero lower bound. How is that altering our ability to meet our objectives? Let's think about it. Let's get some advice from academics, our critics as well, people whose viewpoints we just want to hear more about. And so we had this nice conference in Chicago. We've got a great conference space up there, and staff really did a terrific job accommodating everybody who came in. And we heard a lot of academic papers and then discussants talk about those issues. We had panels of people who, small businesses, they ran small businesses, they, in some cases, they were the head of a first responder labor union. We had community development folks there, and so we heard a number of perspectives, and those were extremely interesting. I think that the academic perspectives you can hear throughout the year at a number of great conferences. These were really good papers tuned to providing us some additional advice. But sort of the community perspective, the small business perspective, we have some of that from our advisory councils, but understanding and appreciating better the many benefits that come from continuing to push a little longer and harder to make sure that you're hitting the maximum employment mark so that as many people benefit from that who are disadvantaged and can form an attachment, certainly as long as we're not overrunning our inflation objective. It shouldn't be the case that we sort of try to be very careful with inflation and we give up on a lot of hopes and aspirations that people can enjoy during those good times. And so I think we hear a lot of good perspectives. We are now in the process of talking through a number of these details and how it can influence the way we do monetary policy going forward. And as I understand it, Chair Powell has indicated at a recent press conference that we're going to work really hard in 2020 and bring this home sometime, I hope, by the middle of the year.
Okay, great. Well, we've got some good questions from the audience. I want to compliment people's penmanship today. We have a lot of students here today, and I said hello to a number of them when they came in. Question, any insight on student loan debt default and student loan repayment, as many students graduate from higher ed programs and are able to pay their loans back?
So student loans are, they're very important. They're very important so that people can, realize their hopes and aspirations, that they can go to college. So it's a tremendous gift. Any parents who can provide a college education to their children without having to access loans, that is such a wonderful gift And, it's really a privilege when that can happen. But, tuition is expensive, and so access to loans is really important. A good college education, understanding the skills that come with that, and your ability to do better, whether it's in terms of entrepreneurship or a career, are really important. So they're really worthwhile. They really have a benefit. Now, it's very important that you actually get a good degree, that that you take advantage of every aspect of it, build on that as much as you can, be successful, because if you take out a loan and then you don't end up with the skills or the credentialing, then you've got this debt and you don't really have the means to repay it. And so there's a lot of good reasons why you would want to have vibrant student loan programs. Now, having underwriting associated with this so that, the various programs fit with the loan and the loan amount, that would be good, but that's not the nature of the program. It's also not dischargeable in bankruptcy and all kinds of things. And so it is a tremendous responsibility that any student taking out the loans, they have a big responsibility, perhaps for the rest of their life, if they don't actually pay it off quickly. And so it does have the potential to slow down somebody's ability to buy a car, buy a house, and so there's a lot of study that needs to be done to understand the burden of that, and also the benefits.
I think a lot of the students that are here are getting degrees in economics. Good field to go into? That was obviously your background.
Well,
it probably depends on the day, like the rest of us, right?
Well, personally, I enjoy economics. I kind of knew at an early age I wanted to become an economist. I don't really know why, but for some reason I did. I think that it builds analytical skills. There are an awful lot of skills right now, jobs, that benefit from those. When they talk about data science and how important that is, and I kind of think about econometrics classes that, I have taken, and I kind of feel like I know some of that stuff, and you're just exposed to a lot of good concepts. But there is, truly high return to analytical skills, statistical skills at the moment, engineering always, things like that. And so it's, it's very important for students to get good advice, seek out advice, get mentoring from faculty members and other colleagues and whatnot, and pursue the best careers that are good for them. Because it is also important that you find something that you enjoy doing, because hopefully you'll be doing it a long time.
Okay, so keep studying, you economics students. Okay, this is a good question. Given we survived 2007-8, what did you learn, and what would you do differently that, to avoid that happening again? What are the lessons learned?
Oh, that's a remarkably loaded question in
Yes.
so few words. On the one hand, it's got that, to avoid, which makes you think, oh, how did we get into that mess? And, there was an awful lot of lending that took place with very poor underwriting, with a lot of risk-taking, where financial institutions, kept piling leverage on top of leverage, and that didn't work out very well. And it's kind of one thing, a capitalist system is wonderful. It generates a lot of wealth and jobs and things like that, but an important part of capitalism is that you benefit from the successful outcomes, but you also bear the penalty and the losses that come with that. And if you don't take the losses when you're due them, then that's a real problem. I think that we just sort of got way out over our skis in terms of leverage and things like that. So you want to avoid that and put in place a regulatory system that helps to limit that risk without choking off economic growth. Mm-hmm. So that's a challenge. Dodd-Frank, and now how we've sort of tailored some of the financial regulations in the aftermath of that are probably putting us in a pretty good place there. Now, when you find yourself in an economic downturn and it's quite severe so that you've lowered your policy interest rates as much as you can, you're at zero. Oh, somebody asked me if I'd talk about negative interest rates, and I said only if somebody asked me. Well, I'll go ahead and mention it.
Okay, I got a couple cards on that, so go ahead and do it, and then I won't answer those.
Well, maybe I'll wait for the cards. But when you find yourself at zero and you have to do unusual things with monetary policy and grow your balance sheet, what did I learn? I learned it's really important to work hard and probably do more than you think you need to do, because, we did quantitative easing version 1, we did QE2, A bunch of people didn't want to grow our balance sheet the third time, so we did it in a different context, and it was called Maturity Extension Program. And then after that, we did QE3, and it was open-ended, and it just, we did an awful lot. And if we'd done more, quicker, I think that would have helped. A lot of people were worried about inflation taking off. Given our experience in the 70s, I understood those risks. They never materialized. There's just a lot of change that has taken place, and we should have been more aggressive. On the other hand, I think we, had a lot of aggressive policies throughout that. It's just with the benefit of hindsight, you can more easily see we should have done more. That fiscal package, that the previous administration passed in 2009, it should have been bigger. Should have been targeted a little better to certain things, yes, but bigger first and make sure that you get it out.
And the wisdom should serve us well going forward. The wisdom will serve us well going forward, all the things we learned.
If we don't forget it.
Yeah. Okay, next question. Can you speak to the relationship, if any, between the Federal Reserve action and the shrinking middle class, the lack of inclusiveness and general economic gains of late in the lower end of the income scale?
In our, so the Federal Reserve, by virtue of sort of paying attention to the economy, looking at data, talking to people, and we've got community development and policy studies group and regional economics groups. We're paying attention to, areas which, might start off as being challenged or are challenged, do comparisons with other, like former industrial cities that were successful. We had a industrial cities initiative at the Chicago Fed where we looked at, some cities that had been successful in the 40s and 50s, but then, hit upon difficult times, and then other cities that sort of weathered that better. What are the lessons for why some cities came back? Indianapolis, manufacturing has been more challenged over a long period of time, and Indianapolis has refocused a lot of attention on, attracting terrific sporting events and things that go with that, conventions and
He's just saying that because I'm sitting here.
And things like that. Well, it's true. Super Bowls and Speedway activities and things like that, and other areas. And so that can work. Everybody can't have a Super Bowl every year and things like that, right? So there are, but looking for strategies that work, and we kind of do that. Now, in terms of the middle class and, how you navigate that, monetary policy is never going to address issues like that per se with changing our short-term policy instrument. That's not how that works. But I would say that, it used to be the case that you could enjoy a middle-class lifestyle with a high school education. You could work in a factory, earn a good wage over time. Those days aren't around anymore. And so understanding what the middle class is, and trying to make sure that people are best prepared for success through education, skills training, and things like that. I think that's what all of us have to keep in mind. From the Fed perspective, we're more of a monitoring how's this going, but through our convening of events and different partners, we learn more, and hopefully successful stories are shared.
Okay, great. Given the upcoming 2020 election cycle, how will the Fed ensure that it's not swayed by undue political influence while pursuing the dual mandate?
Well, this isn't the first presidential election we've been around. We've been in business for over 100 years, so every 4 years these kinds of things happen. We're paying attention to the state of the economy and how different, events might be affecting the economy. So like, trade policies, the pursuit of trade agreements, and they can be extremely beneficial. How you go about doing that can be, the current administration has a different tactic on how to do that, as opposed to, the collective approach that the previous administration and others have done. Now it's more brinksmanship, and to the extent that they're successful, it could be, really quite a boom time. So paying attention to what's going on and how the economy is behaving and trying to position policies. I think at the moment we're well situated. We're looking for the economy to continue to grow, labor markets to continue to be strong. It would take a lot of new data for me to change my opinion about that, and I don't think inflation would have to go above 2% by some meaningful amount for me to really think that we need something more restrictive. So I think we're well positioned to just sort of let things play out, and other people are going to do what they're going to do.
Okay. Can you discuss your thoughts on the federal deficit and debt and how it affects your policy at the Fed?
Well, as I sort of mentioned before, when we had the great financial crisis and the recession, it would have been helpful if fiscal authorities had provided more lift for the economy. In the United Kingdom, they went through a period like that too, when they went through a period of austerity where they cut back on spending. Now, the most recent Boris Johnson, I think I've heard some comments that they can do more spending. And interestingly, because they had been so difficult before with austerity, now the same party is saying, well, now we can, spend a little bit more. That would be more helpful for supporting the economy. So to the extent that fiscal authorities can support the economy during a cyclical downturn, that would be good. Now, what just happened with the corporate tax reform, with all of its benefits, it was passed with the ability to increase the national debt by $1.5 trillion over 10 years. That kind of gets in the way. That's pro-cyclical fiscal policy. At a time when the economy is doing well, they added more stimulus to that. And so that's kind of unusual relative to, we think of counter-cyclical policies. It also sort of reduces the capacity, depending on the level of national debt that the economy can readily bear. So when other actors aren't able to bring helpful stimulus ammunition to, to the party, people look at the Fed, and that's how we end up growing the balance sheet as much as we do. So if other people do more, we can do less. Mm-hmm. And perhaps we all do enough, and that would be a good outcome.
Okay, there are many not-for-profit and education organizations here in the audience today. What role from the philanthropic sector plays in the Federal Reserve's decision-making and thoughts?
Well, we think about workforce development issues quite a lot. We think about, as an economist, monetary economist, we like to think about this single national economy where everybody's enjoying equally in the growth in the economy. But of course, as we know, it's very uneven. Urban areas have their own challenges, rural areas have their challenges. A successful, relatively small community that has one or two large employers and maybe a hospital system can be successful, but then all of a sudden something happens and the employer leaves town, and then there's a lurch. A lot of time nonprofits, economic development, community development groups, are interested in helping out, making sure that the workforce has the skills so that you can attract the businesses to make sure that everybody enjoys in the prosperity of the area. So I think they're very important. They're very important, in this. So it's not the top level that we're paying attention to in the Federal Reserve, but the infrastructure, the support is critical, obviously, to the success and everybody enjoying prosperity. Especially when we are in good times like this. So I think serving on, working with nonprofits, working at nonprofits is really valuable. If you've got time to be on the board of a nonprofit, that's unbelievably valuable. So I just think it's a good public service.
Okay. We have a couple questions regarding the recent death of former Fed Chair Paul Volcker. And one of them was, in his many contributions, he's perhaps best known for taming too high inflation in the 70s. And then also your thoughts on the Volcker Rule. So for those of us who don't necessarily know what the Volcker Rule are, maybe you can educate everybody and then talk a little bit about him and his legacy.
Paul Volcker's an institution within the Federal Reserve institution. He's a giant, literally very tall. And he just was a real champion for all of us back when, in the 70s, inflation was raging at double digits, when the Federal Reserve, through no intent, they didn't have bad intentions, but it's just that the way to address the double-digit inflation that we were experiencing meant that monetary policy was much too accommodative, that we needed to have a much more restrictive monetary policy, but that was going to have a negative effect on the economy that would drive unemployment up, and there's no politician who wants to run next week, next month, next year, 3 years from now, in the middle of a recession or something. And so it was easy for too many people to sort of put off the bitter medicine. Paul Volcker became chairman. Jimmy Carter appointed him. Jimmy Carter must not have known exactly what Chairman Volcker was going to do, but to his credit, he appointed him. And then interest rates, short-term interest rates, skyrocketed to 18.5%. That restricted credit dramatically. There were some other credit controls as well. And we had a horrific recession, which broke the back of double-digit inflation. It was a relatively quick recession. It's actually one of those that was the so-called V recession, went down steeply, but then it came back. And it was morning in America back in 83 and 84. It was also a different labor market where there were sort of temporary layoffs, and we don't have those anymore. But he was able to guide the economy to the place where it needed to be. He suffered intense criticism during that time, and we're all in a much better place. And so we think about how he was criticized. There are pictures of him testifying in Congress. He was a cigar smoker back at a time when you could smoke cigars in an office of all places, or a hearing, and so there's smoke covering him, things like that.
And a 6'7", if I remember right.
Okay, you've got it. That's right.
Yeah, 6'7".
Right.
That's
very intimidating.
Tall. Yeah,
yes,
intimidating
that's
guy.
Right.
Yeah.
But he did a great job, and he got inflation down. Mm-hmm. So that was good. Now the Volcker rule. So the Volcker rule.
Don't get too academic on us on it.
Well, I can't explain it then.
Okay. Okay, try.
So basically, he was responding aspirationally. The concern was that, commercial banks, true commercial banking is you take in deposits, you make loans, you make commercial loans, they're well underwritten, people are creditworthy, they pay off, and you grow, the economy. So then there are other types of loans which support financial market activity and perhaps trading of assets. And while those are worthwhile in terms of improving price discovery, it's a little harder to know exactly when it's outrageous speculation or not. And so Paul Volcker had the idea that banks which supported more of this speculative type activity, if I could be so loose as to use that language, as opposed to the commercial banking side, ought to be limited in the percent of the amount of lending that they do on their private account, that type of thing. And it was extremely unpopular from the standpoint of people who made a lot of money in doing those kinds of activities. And it was very hard to explain because it was,
I can see that.
Yeah, that's right.
Okay, this is straightforward. What are you watching in the equity markets for 2020?
I'm a conservative investor myself. I think that, markets, we've had tremendous tax reform, tax relief, regulatory relief has, improved dramatically. These are natural things that would justify higher valuations of most financial assets. We have seen strong growth in the value of these assets, and so there's always a question as to the valuation. We look at that. We do a financial stability report, and 4 times a year at the FOMC, we talk about what's the state of financial instability risk, and equity valuations are one of them, but also underwriting standards, the amount of leverage that financial institutions might have, households, businesses. We try to look at sort of everything with an eye towards, it looks like people are pursuing reasonable investment strategies, trying to support credit intermediation, which grows our capital stock in the economy, and those are good things. But, is there, too much risk? It feels moderate at the moment, but every quarter we talk that out again.
Okay. We have a few questions on retirees and the aging population. So given the aging population in the U.S., how does the Fed weigh the benefits of easing through low interest rates against the cost on this growing segment of our population?
Right. So one of the more intense criticisms I can receive is that interest rates are low and that punishes savers who have saved their entire career, done everything right, and now at the moment when they need income the most, interest rates are low. That's true. Now, one thing about monetary policy, we've sort of got this one tool. We raise interest rates when inflation seems like it's too much of a problem, and we lower interest rates when the economy needs a little more inducement and maybe inflation is too low. It's a very blunt tool. In an ideal world where you could solve all of these problems quickly, we'd have short periods of low interest rates and then they'd be followed by a ramp up. And then there are other times where we raise interest rates and presumably the same people, the savers, are getting benefits. And so over a longer period of time, it should average out. But we've had this long period after the great financial crisis where the savers were really harmed by the financial excesses that led to that, and we've just had to try to do the best that we could, and we've had to keep interest rates lower. Getting the economy going is important for everybody, and the alternative, which is kind of hinted at in this question usually, is why don't you just raise interest rates? You should be raising interest rates, and problem with raising interest rates when they should be low is you're going to go back to low interest rates. You're just going to be in a deeper recession because it was the wrong policy to pursue. Now, if you had the fiscal authorities provide more support, and we have just increased the national debt by a material amount, so you might think that that would lead to higher interest rates. You have to be surprised that treasury rates aren't higher with the prospect of a rising national debt. So there are many things at work that seem to be defeating this prospect of higher interest rates. And a little bit of it's a puzzle. We have to keep our eye on our mandate and try to get there as quickly as we can. Getting there as quickly as we can is one of the best ways to help everybody out.
It's an interesting question about youth. Recognizing...
I don't know what an A answer is to that question. Do you guys give at universities? I'm pointing at Greg Hess because I know him from his Federal Reserve days. But, student essays on that. We should have a contest. Who gets an A on that answer? If I got a C, I'd be happy on that one.
Recognize the importance of financial literacy for youth. Do you have a recommended age or program on when we should start teaching our kids about savings and monetary policy? It doesn't say that.
Monetary policy.
If we're going to try to educate our children on the importance, the youth, on the importance of saving, the importance of living a lifestyle that way, do you have a program that the Fed recommends or an age to start talking to kids?
We have a Money Smart program.
Okay.
We focus a lot of attention on existing programs that private institutions have. We have a lot of partners. We have our own programs that working in classrooms, educational help for teachers teaching classes. But this idea that your children and anybody else growing up should have an understanding of budgeting, interest rates. If you save, if the Fed will let you have an interest rate above zero, you could earn this, that type of thing. I mean, it is fundamental. Apartments are expensive even after you get a good education.
Cartoon books?
Cartoon books, yes. The New York Fed has a long history of good cartoon books. Having materials that are accessible to students is
important.
Is very useful, but
Okay, good answer. All right.
I don't know, how do you prepare?
Well,
your son obviously has learned a lot. He's a graduate student at Purdue studying economics.
He manages all my money. I don't know how to teach him. Okay, I think we have 2 minutes left, and we get everybody out of here on time. This is my favorite question of the day. So whoever wrote it, congratulations. It says, "I am ignorant on most of what the Fed does. What is the most important Fed fact that I need to walk away with today?"
Wow. Gosh, after all of that.
After all of that, narrow down to what's the one takeaway on the Fed that people should walk away with today.
I mean, of all
it is a lot, for the average person. It is even if you follow it, it's a lot to understand.
Right. The Fed's involved in a tremendous amount of activities. And so answering the question by mentioning that we're involved in financial services, and we just have announced that we're about to develop a real-time gross settlement savings so that people can do real-time payments. Have you ever had to make a payment to somebody like 10 minutes from now? You know, you missed a payment deadline.
Usually it's to our kids, right? Except
Yes.
mine, not mine, but yeah.
Yes, the example I give is when my son was at the University of Iowa on a
Yeah.
Thursday evening, he said, "Dad, I need money." And I go, "This is the worst day of the week to tell me that, because I'll make an ACH transaction start. It's 2 days, 2 business days. You'll get it Tuesday," that type of thing. We do a lot of things. But really, I think that in terms of things that matter to everybody, getting the economy going, vibrant labor markets, I think what's most important is that we maintain true to our mandates to pursue maximum employment and price stability, and we do everything within our power to get there as quickly as possible, because we've just gone through a 10-year period where it took us a long time to get to this nice labor market experience. And inflation is up, it's got a ways to go, but we just need to work as hard as we all can to get there so that we're prepared, and then we can, sit back and enjoy the benefits of that.
Okay, good. Well, that was a good takeaway. Well, I want to thank you for coming today.
Thanks very much.
Greatly
This is a tremendous
appreciated having
experience.
you in
Thank you very much.
Indianapolis today.
Thanks.
We appreciate your work. I'm sure it's not easy every day with everyone, in your business. So thank you for the work that you do. I want to invite everybody to join us next month. Our January speaker is Chris Baggett, and if you are not familiar with Chris, he is fascinating. One of our city's most successful entrepreneurial and innovation stories. So please come back. That date is January 23rd. So mark that on your calendar, and maybe buy someone a ticket for the holidays to come to Chris. That would be a good idea. He's very popular with the young folks too, but he's a great story, so come and see him. And I want to thank you for coming today, and everybody have a wonderful holiday. So thank you for joining us, and we'll see you next month.